While selecting stocks, we can go bottom up or top down. Bottom up is when we go company by company and select those companies that meet some acceptance criteria. Top down is when we look at the market overall and then use some factors to select the stocks. There are some established factors that have been researched and are used to select portfolios. The most common ones are value, volatility, size, quality, and momentum. At Smart Values, we use momentum exclusively to select our portfolios. Momentum has a track record of outperformance, and an investment in the BSE Momentum Index in the last 10 years would have fetched over 4x returns, as you can see in the graph. Momentum investing has gained popularity, especially in the current bull market. The strategy revolves around capitalizing on trends. Um, if you can get onto a uptrend, that can prove highly profitable given the right market environment. There is a misconception that momentum is primarily targets short-term gains, but like everything else in the market, trade duration is a function of the time frames that you're operating with. At Smart Values, we operate with long-term momentum. Momentum investing involves purchasing assets, usually stocks, that are currently experiencing upward price movements and selling them when these trends begin to lose momentum. The strategy aims to capitalize on the ongoing rise in stock prices to generate profits. At its essence, momentum investing operates under the premise that trends in the short term tend to continue, and therefore a stock that has been rising is expected to continue to rise, while a stock that has been declining is expected to continue to decline. So the existing trends get accentuated into the future, a bit like Newton's laws of motion. At the heart of every extended bull market, one will find momentum investors who focus on stocks that have demonstrated significant gains in recent periods, such as the past few months or even the past few years. Momentum investing is fundamentally influenced by psychology. The strategy hinges on the belief that investor sentiment can magnify trends. As a stock price climbs, more investors may join in, further pushing up the prices. It's based on a psychological state called FOMO, or fear of missing out the momentum. Momentum investing is a strategy that is strictly technical. That means that it has no care for the company's operational performance. There is an inherently psychological aspect to momentum investing, as analysts are trying, if possible, to understand and anticipate the behavior of other players in the market. It is a unique strategy, one that is driven by the juxtaposition of human behavior and rational decision making, as well as rigorous quantitative analysis. Social psychology has always had a strong connection with stock market investing. There has been a lot of research that has been done in this field, and one of the most famous ones is called the prospect theory, which earned the authors the Nobel Prize for economics in 2002. This paper challenges the conventional rational behavioral bias for human decision making, including investment decisions. It showed that people value gains differently from the way they value losses. This became known as loss aversion. Overall, the theory helped explain why individuals make decisions that can deviate from rationality. The paper formed the basis for identifying other systematic behavioral biases. These biases help explain the psychology of momentum investing and why it works and has been persistent over the years. The major psychological linked facets are used to understand the human aspects of momentum investing. Some of these psychological aspects of human investing that are examined and explored by the subject of behavioral finance are Anchoring. This is the tendency to overweight the importance of the first bit of news. People tend to anchor their views to past occurrences and are reluctant to adjust their views to new information. Anchoring causes inertia, which causes people to underreact to news, keeping prices below their fair value. But once the price trends develop, they remain strong for some time as prices catch up to the fair value. So initially, there is um, underperformance of the stocks as the market tries to assimilate the new information. And then once the new information is assimilated, the price adjusts, but not instantaneously. It adjusts over a period of time, which forms the basis for these trends. Very closely linked to the anchoring bias is what is called the confirmation bias. This is the tendency to overemphasize the importance of information that confirm to our views. George Orwell said that people can foresee the future only when it coincides with their own wishes. And the most grossly obvious facts can be ignored when they are unwell. Investors subject to confirmation bias look at recent price moves as representative of the future and may invest more in securities that have recently done well, which can accentuate existing price trends and lead to their continuation. Then there is herding, feedback trading, and overreaction. Charles Mackay wrote in his classical book of 1841, Extraordinary Popular Delusions and and Madness of Crowds, that men, it has been well said, think in herds, it will be seen that they go mad in herds while only recover their senses slowly one by one. Herding is primordial. It manifests itself when an animal stays with the crowd in order to reduce the risk of attacks. Herding is deeply ingrained in our brain chemistry and DNA, and herding also explains the existence of trends. Then there is conservatism and representativeness. There is evidence that investors initially underreact to news because of conservatism. Again, inertia. They do not wish to change their views. They then overreact over a longer period due to representativeness, which is when we see things that are familiar and draw parallels between events that are not the same in the case of investors. Investors tend to see recent price strengths and assume that it is indicative of favorable conditions in the future. And they lock into those stocks and keep buying it, which accentuates trends. Another very pervasive bias is the overconfidence and self-attribution bias. We are prone to overestimate how much we understand about the world. Overconfidence also triggers the hindsight bias, where individuals believe that past events were more predictable than they actually were. They also tend to go towards self-attribution, where they attribute success to their own skills, but failures to external factors or bad luck. Investors buy because of overconfidence, and that pushes up prices. They then react to or overreact to confirmatory news, which prolongs the price trends. There is also this issue of slow diffusion of information in the markets. Markets don't absorb information instantaneously. Information diffuses slowly and continues to do so over a period of time. Some academics like Chan, Jagadish, and Lokonchikov posit that this is the reason why relative strength momentum works best over 6 to 12 months, because it takes that long for analysts to adjust to new information. The relative strength momentum over 6 to 12 months is a very, very powerful tool to be able, which enables people to identify trends. At Smart Values, we use this method quite extensively and has proven to be quite successful for us. Disposition effect. This is another aspect of the market that leads to um, the formation and continuation of trends. Disposition effect is the tendency of investors to sell their winners too early in order to lock in gains, while holding on to losers too long in the hope of making back what they have lost. The reason for this is mental accounting, regret aversion, lack of self control, and tax consideration. Disposition effect leads to underreaction to news events among investors. Prices do not immediately rise to fair value with good news, and prices fall less than they should because investors are reluctant to sell. So these are some of the psychological reasons why momentum works. There are also logical reasons why momentum works, though some of those reasons may appear to be obscure and vague. There is a link below with a recommended reading list for those who would like to explore this area in more detail. So, as the famous economist Richard Thaler said about the contrast between efficient markets and behavioral finance, it's a choice between being precisely wrong or vaguely right.